Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers. It's Friday, March 13th, 2026, and we're ready to break down the latest market insights.
That's right, Ethan. We've got a fascinating batch of data to unpack from yesterday, March 12th. Our AI flagged quite a few different stocks with significant social media buzz. The overall sentiment, I'd say, is a real mixed bag today. Some truly promising growth stories, but also a healthy dose of skepticism, and frankly, some very high-risk profiles.
Absolutely. From what we're seeing, there's a lot of chatter around geopolitical impacts and, well, the usual speculative plays. Let's dive in.
First up, let's talk about CF Industries Holdings, Inc., CF. We saw a solid 18 posts yesterday.
Yeah, CF is looking really interesting, Brooke. The market commentary is overwhelmingly bullish, primarily driven by these ongoing geopolitical tensions. Think about it. Disruptions in the Middle East mean a curtailed global supply of fertilizers, while spring planting demand is about to surge. CF, as an American manufacturer, is perfectly positioned to capitalize on that. Users are even calling them a Strait of Hormuz workaround. This scenario, could lead to higher prices, increased market share, and expanded profit margins. Their sentiment score was a strong +8.
I hear you, Ethan, and the geopolitical tailwinds are certainly compelling. But let's look at the numbers. While their revenue growth at 0.228 and net profit margin at 0.205 are solid historically, we need to consider how much of this potential upside is already priced in. The stock is trading very close to its 52-week high of 137.44 at 13600. While the PE of 15.16 isn't exorbitant, investors are betting heavily on future amplification of these numbers. The news does corroborate rising fertilizer prices, which is good.
Exactly. That near 52-week high just shows the market is already reacting positively. The discussions are all about future impact, how this unprecedented scenario will amplify their already strong financials. I mean, if these predicted price surges and demand materialize, those revenue and profit margins are poised for substantial improvement.
True. The news of Holly accusing them of price gouging suggests they certainly have pricing power. Given the current dynamics, their strong historical metrics combined with these future catalysts could indeed justify further gains. My read is a clear buy for CF. The market conditions are uniquely favorable, and their strategic position is undeniable. Okay, next, Palantir Technologies, Inc., PLTR. This one, always gets a lot of discussion, but the initial post showed a negative YTD change.
Well, yes, the user's portfolio showed a negative YTD of about negative 6.81%, but that's a snapshot. When I look at the news, Palantir is constantly expanding its AI partnerships, LG CNS, Centris, even Ondas. There's real optimism that March could be a turning point for the stock, with some analysts even suggesting it could set you up for life. Their revenue growth is stellar at 70%, and their net profit margin is a healthy 36%. These are the fundamentals of a growth story, especially in AI.
Ethan, that's where I have to pump the brakes. A PE ratio of almost 240? That's pricing in perfection and then some. Their beta is 1.739, meaning it's incredibly volatile. News even mentioned a recent 27% drop, asking if it was a collapse or a buying opportunity. That kind of swing is a huge risk. And let's not forget the insider selling over the last 6 months. Net sales of over 2.2 million shares, or 2.72% of total insider holdings. That's not a strong vote of confidence from within. We've rated Palantir as stay away many times before, and just last month it was a speculative gamble.
I see the valuation concerns, Brooke, but the ongoing partnerships could certainly help them grow into that PE over time by accelerating earnings. The AI space is just exploding.
It could, but that's a big if. The current metrics scream high risk. For now, it's a stay away for PLTR. The valuation simply leaves no room for error, and the insider activity is concerning. Moving on, INMD Limited, MIND. We saw 13 posts for this one. One user was quite bullish about looks maxing.
The original post made a strong case, Brooke, highlighting the looks maxing trend and MIND's apparent undervaluation with a low PE of 8.92 and significant cash. They've got fantastic margins too, like a 25.3% net profit margin. I mean, this looks like a company poised to capitalize on a cultural shift.
Hold on, Ethan. The user comments were overwhelmingly negative and dismissive of the looks maxing trend, calling it a dumb internet fad. There's also skepticism about the efficacy of their radio frequency technology. More importantly, the bullish post claimed no debt, but our debt-to-equity ratio shows 1.204. That's a significant misrepresentation. And the big news? InMode announced they're discontinuing their potential transaction process. That means the $18 per share private equity offer the original post highlighted is off the table. That was a huge catalyst, and it's gone. This stock is trading at $12.76, well below its 52-week high of $19.08.
Okay, the discontinuation of the transaction is a blow to the short-term catalyst, but the underlying profitability and the potential for a new market segment could still be there, even if the looks-maxing name is, well, a bit cheeky. Their Q4 2025 earnings showed some positive non-GAAP performance.
Not enough to overcome the fundamental skepticism and the factual inaccuracies in the bullish argument, Ethan. The low PE looks less like undervaluation and more like justified caution from the market. I'm calling a stay away on MIND.
All right, next up, Reddit, REDT, with 18 posts. A lot of debate around this one. Now, Reddit has definitely seen a year-to-date decline, about 43%, which one user called a divine comedy. But the sentiment quickly shifted to future prospects. Some very well-reasoned comments project forward PE of 25 for 2026, with revenue growth of 50 to 70% expected, and profit margins possibly hitting 40 to 44%. Think about its value as Wikipedia for AI. That data asset is immense. Plus, we're seeing aggregate insider buying over the last 6 months. That's a sign of confidence from within.
Ethan, the current PE is 50.47, not 25. That's a huge valuation, even for a company with 69.7% revenue growth. The market is pricing in extremely aggressive future growth and margin expansion, from 24% to 40 to 44%. That's a significant leap they need to make, and any stumble will be severely punished. While the AI data potential is there, it needs to translate into verifiable revenue and margin growth. And while there's aggregate insider buying, news specifically highlighted an insider selling over $1.2 million. The current price to book of 8.6 is also quite high. We've mostly rated REDT as stay away in the past.
I agree it's a demanding valuation, but the long-term vision and that AI data asset are significant. If they execute on monetizing that data, especially for AI, those KPIs will improve, and that PE will come down to a more reasonable level relative to earnings. Potential? Yes. But at this moment, with that PE and the need for perfect execution on future projections, I'm sticking with a stay away for REDT. The risk is too high given the current price. Finally, SM Energy Company, SM. 23 posts on this one.
SM Energy is another one feeling the geopolitical tailwinds, Brooke. Users are pointing to a PE of just 4.5, which, is incredibly low for an oil company, especially with the Strait of Hormuz in the news. Some industry insiders even speak highly of their operations. They've got a decent dividend yield of 3.2%, and analysts are raising price targets. Plus, their active debt management, along with recent insider buying, gives me a bullish lean.
Ethan, that low PE is certainly eye-catching, but it needs context. The debt-to-equity ratio is an astronomical 59.314. That level of leverage is a massive red flag. And crucially, the reported revenue growth is negative 0.171. A low PE for a shrinking, heavily indebted company isn't necessarily a gift. It could be the market accurately valuing the inherent risks. Users themselves raised concerns about political intervention, like export controls or price caps, which could severely impact domestic oil prices. Some even called SM late to everything or a disaster. Okay, the debt and negative revenue growth are certainly concerns, but their proactive debt management, including recent notes offerings, shows they're tackling it. And if oil prices remain high due to global tensions, that revenue trend could easily reverse. Could, yes. But for now, the high debt and negative revenue growth, coupled with external political risks, make it too speculative for my taste. That low PE just isn't enough to sway me given the other metrics. It's a stay away from SM.
All right, let's wrap up our hunt for today. Based on our AI-generated insights and market commentary, here's our compiled list for deeper analysis. Investigate as buy, CF Industries Holdings Inc., CF. Investigate as cautious buy, none. Investigate as speculative gamble, Reddit Inc., RDDT. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers.
We'll catch you next time.